right here it's Friday, the 1st of November 2024 with your weekly video update. I'm going to be a little all over the place in this presentation. I want to start though with some notes from our internal log from the last few days. And I guess I'll just jump in there and then take you along. We'll finish with some technical looks at stocks, etc. So first of all, today's jobs report, we can completely dismiss it in terms of the 12,000 jobs that were created. We can dismiss it because of the hurricanes and strikes, things such as that. What we shouldn't dismiss, though, is the negative 112,000 revisions for the past 2 months. Remember, I said recently that in an economic slowdown, in the months heading into recession, if that's where we're going, you tend to see pretty consistent negative job revisions. We did get a hiatus here the last month or two, but we're kind of back in those negative revisions. I fully expected last month's number to be revised. It was revised by, I think, 40 or 50, part of that 112. Could be further revisions as we go. But when you square it all, and we'll look at some of the other jobs data here in a minute or two, nothing really gets in the way of the notion that the Fed isn't going to hike, or is going to, not hike, but cut over the next 2 months. I mean, there's been some concerns. You've seen yields pop here recently, and we'll look at that as well, over perhaps election odds, but also over some of the data that have come in and fear over rekindling inflation and so forth. We did get some inflation numbers this week, which we'll talk about. But so there was some concern that maybe the Fed might pause, and I don't think that's likely. Right now, pretty much 100% odds are priced in that we get a 25 basis point cut this month and another one in December. And right now, I don't see anything that gets in that way, but something could between now and then, or at least now in the December meeting. So bonds, interestingly, rallied. Yields fell notably on the jobs report early this morning in the pre-market. However, and you'll see it in a chart here in a couple minutes, they gave all of that back and some. In fact, bonds are kind of tanking right now, at least they were when I started the video. And they rolled over on the ISM manufacturing survey release for last month. The overall score actually worsened, but the internal components weren't all that bad. We're not going to get deep in those weeds today, other than the fact that the prices component, prices paid, actually popped. And I am going to show you that on a chart. Hence the abrupt turnaround in bonds this morning. So the dollar sold off on weaker jobs data with lower interest rates. Once the ISM data came out, both turned around, and bonds have continued to fall, and yields have continued to go up. That normally is a headwind for stocks. Stocks are enjoying quite the rally, but I should qualify that and say not all stocks. It's really pretty much a tech and consumer discretionary rally with last night's Amazon results. Materials are down, energy's down, staples are flat. So most of the market is flat to down. Commodities have rolled over today, and so on. So not a great day for the market overall, and we'll see how it ends up. Right now, indexes are higher on the back of some tech, and not Apple, by the way, but some tech, and certainly on Amazon. Okay, so another note. Considering what and where to emphasize in a soft landing scenario. Now, that's still not our base case, but as I've been reporting each week, we're getting closer to that, more of kind of a neutral look at the economy, or outlook on the economy, as opposed to a recessionary outlook, but still on net a recessionary outlook. In fact, our PWA index dropped 4.5 points to -9, so we're moving back in the wrong direction this week. The following statement from Martin Marietta may be telling. In fact, in a recession scenario, the true to form fiscal response tends to lean on infrastructure. So my point is, we're looking at where we need to tweak our core allocations if indeed the data continue to improve. But I make the point here that even if it doesn't, Infrastructure is where fiscal policy tends to go during a recession. So Martin Marietta is, we've been in Vulcan Materials in the past, so this is just an example because of their earnings statement. They're a maker of aggregates, gravel, crushed stone, concrete, etc. From their earnings call, looking ahead to 2025 and beyond, we expect to benefit from record levels of federal and state investments in highways, streets, and bridges. Additionally, reshoring and the build-out of artificial intelligence infrastructure should provide steady growth in these aggregate-intensive end markets for years to come. Materials, while still sporting a pretty hefty price-to-earnings ratio, have not been stellar year-to-date performers, third worst behind healthcare and energy, by the way. Speaking of energy, which is another thing we need to pay attention to, it's far and away the cheapest sector going right here. As you can see, it's trading at 13 times 12-month earnings, trailing earnings as opposed to forward earnings. It's only in the 27th percentile of its 10-year average range. Price to book is very attractive dividend yield. So that's energy, though. That's not materials. I mentioned materials. They're still trading at 25.4 PE in almost the 90th percentile. Price to book, they're relatively attractive. Dividends, okay. But, contrast that with where everybody is piling up. Tech is trading at 41 times earnings. Let's just put it this way, they're as expensive as they've ever been. 13 times book, and they pay almost no dividend. And by the way, they make up 32% of the S&P 500. Last time they did that, or were approaching that in a bubble, they took a massive, 75-80% hit. The next sector to get that kind of concentration was financials, right before the great financial crisis, and financials took an 80% hit. I am not forecasting, by the way, an 80% hit. But if this market does ultimately take a hit, tech is probably not where you want to be based on these valuations. And then speaking of that, analyst Charlie Bolello does a nice podcast. I ran into that, and he had some charts or some statistics that are consistent with what I've been complaining about or concerned about. Over the last 10 years, sales per share for the S&P 500 are up 68%. Over 10 years, that's not much. Earnings are up 92% over 10 years. That's not stellar. Prices up 202%. So this is just all what we call multiple, as in price to earnings multiple expansion. It's not about fundamentals. So stocks are pricing in a fabulous future. And as I say here, the street expects earnings to continue to ramp right on through next year at just a breakneck pace. Pretty amazing, frankly. The S&P is pricing all of that in at these levels. So the price to peak earnings ratio is virtually at an all-time high. Again, 1999 was where you get the ultimate all-time high. And there are other valuation metrics that are right there, by the way. So in yours truly's humble opinion, these are exceedingly lofty expectations. As I've been stressing, the mania around AI spending is breathtaking. Google, CapEx, Microsoft, Amazon, Meta, it's really off the historical charts. And that's all good for NVIDIA, right? Look at 96.3, billion revenue, net income, you name it. NVIDIA is just capturing everything that's going on in this market virtually. But per yesterday's earnings call hints, the day before I wrote this, we may be a long way from all that spending translating into anything that remotely justifies it by way of earnings generated. Next year projections, again, I'll say, are historically lofty. So on Meta, this is from Bloomberg after their earnings call. Even though Meta's long-term AI investments are still years away from contributing meaningful revenue, Meta has leaned on AI advancements to improve its ad targeting and content recommendations. So here I am complaining about the billions that they're spending, and Meta saying, hey, but we're turning that into profits, at least in some places. So my question is, will that be sufficient to offset all this CapEx? And of course, I ask a tough question. And here's a follow-up article from Bloomberg. Meta did warn investors that losses from its division focused on artificial intelligence and augmented reality will continue to widen meaningfully this year, putting pressure on its core advertising business to fund the effort. Meanwhile, the ads business, even with the recent AI improvements, isn't generating the kind of momentum. It's been good, but not what Wall Street was hoping for. Okay, so there's that. And then Microsoft sums up my concerns to a T as well. Quarterly capital expenditures, call it $15 billion, up 50% from the period a year earlier and exceeding everyone's expectations. Now, prior to 2020, Microsoft had never spent that much in an entire year. So this is AI mania, make no mistake. From an analyst with Davidson, our fear is the more they throw into data center build out, the more drag it's going to be on margins. They downgraded Microsoft to neutral. They've been able to cut enough costs elsewhere to expand margins. So the big problem is, how are they going to monetize this and really justify all this spend? Now, folks, there's a fascinating book called The Engines of Markets, and it takes you back all the way through history and the advent of all technology pretty much that's worth talking about, and has it's changed the nature of how we do things in business and transport things and so forth. And without exception, every new technology came with massive capital expenditures, just absolutely a race, because everybody had to do it to keep up with the competition. In the early 1900s, believe it or not, there were 10,000 automobile companies in the U.S. Remember all the dot-com companies in the late 90s. So folks, AI feels a lot like that. And if history runs true to form, there's going to be a shakeout. And a lot of these companies that are, new or expanding or what have you, have potentially got some hell to pay before this all plays out. AI is definitely here to stay, just like the internet was here to stay. It just was quite the devastation to those who just got way too far out over their skis. Okay, so I'm taking a long time today. I'd mentioned the 12,000 jobs print, unemployment stayed at 4.1. Interestingly, our average hourly earnings actually picked up. That was a surprise. The quits rate continues to drop. That's a negative sign for the economy. People don't quit their jobs when they're worried about their jobs. Job openings really plunged this last time from like 8 million to 7.4 million. Labor force participation rate is steady. U6, which captures part-time workers, yada, yada, remained pretty steady. The household survey showed a decline of 368,000 jobs. The household survey, probably speaks more to reality, because those aren't establishment surveys where you didn't get much participation because of the hurricanes. This is, phone calls to households. So this looks, potentially recessionary, and definitely keeps the Fed engaged, but there's nothing here that would have you panic. Let's just put it that way. Manufacturing Purchasing Managers Index, as I think I mentioned earlier, came out today. The sentiment declined. We'll get services next Monday or Tuesday. The prices paid index, this is what I talked about. This is where bonds sold off on this news. They were rallying on the weak employment news, and then they sold off, which means yields went higher. Dollar did virtually the same thing as well. Caterpillar global sales. We track this quarterly. They deliver that now when Caterpillar delivers their earnings. So this speaks to certainly construction or infrastructure work the world over. Worldwide, you can see down 10%. Asia down 9%. North America down 9%. Still slightly in the green. Actually, it was no move for Latin America, and less so sales in Europe, Africa, and the Middle East. So again, and I'm talking about materials and so forth. So I suspect that, again, in a good economy scenario, no recession scenario, activity picks up. Caterpillar probably does pretty well. I know the stock got hit pretty hard on that earnings news. But right now, the results worldwide are suggesting anything but, a robust economy. And then speaking of that, by the way, so we do our own work, as you know, but we also pay for a few different research firms, but two in particular are very established. In fact, one is the oldest research firm on the planet. And they both have good teams, analysts and economists. And interestingly enough, they more or less differ. Then it's great because we get to test our theses against theirs. But the one that happens to be the oldest on the planet, they have a very concerned view. They see recession, albeit probably a mild recession, beginning early 2025. Odds favor that. The other firm does not see recession coming in 2025. They do see one on the horizon someday, but right now they say that the global economy is strong enough and robust enough to make it through 2025 in pretty good stead. Now, both firms are relatively negative equities. The firm that sees recession next year has a bias towards U.S. equities relative to the rest of the world, but they still say underweight equities. The other firm that actually is bullish on the economy next year says underweight U.S. equities, favor emerging markets and other developed markets. And it's interesting because while our macro view or economic view actually is sympathetic to the former, our asset allocation view is actually more sympathetic to the latter. So lots to parse. It's a good time to stay diversified, stay hedged, stay pretty liquid, and just let some of these things play themselves out. So PCE, that inflation data that came out this week, you can see that the headline is coming right in close to the Fed's target, although the monthly popped up here just a little bit, so that's annualized. Core PCE, which X's out food and energy, is still too high at 2.65%. I mentioned that prices paid index. Oh, the employment cost index, that's favorable for what the Fed wants to do. Still high historically, but moving in the right direction, so that would be disinflationary. And now let's just jump to the technicals. So interestingly, as I speak, the S&P is trying to give up today's rally. So we had a really nice pop. The Dow is still up 274 points, so that's going to reflect the obvious, contribution of a big stock or two. But the equal weight index right now is flat, and the S&P is still up, but a little less than 0.5%. But tech stocks are still up about 0.2%, and they were up well over 1% here a little bit ago. So we'll see if this rally continues to fizzle. There's about an hour and a half left in the trading session. VIX was down, the volatility priced into options, but it's come back up a little bit as well. It's still 22.5, which is high and a somewhat dangerous level for the VIX. Our core portfolio is actually now down a little bit. We had a good day yesterday. We captured just, not even a third of the big decline in stocks. Yesterday, stocks had quite the decline. But today we're not capturing the rally. We're down 21 basis points. Gold has rolled back over. It's now down 0.4%. Staples are flat. Healthcare is up 0.69. That's a pretty good position for us. But a lot of the international stuff is down. Utilities are down 2% today. That's a big hit, and they've been doing great this year, by the way. A mixed bag. Very poor breadth for this rally. Right now, I'm looking across sectors. Materials are down. Energy's down. Commodity-oriented stocks and commodities themselves are down and so forth. Utilities, as I mentioned, are way down. So, not your broad-based rally. Like I said, the equal weight index is flat right here. So, interesting day. Again, big ramp early, but that's fading, and who knows? It's Friday, end of week. We could get a markup into the close. So, as for the chart, though. So folks, we broke out of this rising wedge pattern. This is the S&P daily chart. Gap down yesterday. Remember I said yesterday was a big down day. It was. And found support right on that 50-day moving average. You can see how important that's been. So you don't want to break that with momentum because technically speaking, there's quite a bit of space below that right here. And you can see this candle today. The top is where it was at one point. This body captures where the opening was and where it currently sits. So a lot of that rally has been given back. The way we do the technicals, as you can see, bearish rising wedge with negative divergences and an accelerating sell signal on the MACD. So we'll see. We could very well come popping out of that. Next week is that election. So we'll see if that's a bullish or bearish event for stocks. The NASDAQ 100 index, or the ETF that tracks it, has lost its 20-day moving average, which has been important, and broke down below this pretty well-defined trend line right here with that big, terrible candle. It was down over 2% yesterday. We had the pop today, still sitting or finding support at that 50-day moving average. So we could come barreling right back through there, no problem. But if all I were looking at were the charts, I would say, this is still a precarious setup. And the longer it stays precarious like this, we could get to marginal new highs and still have these divergences. It's still going to be a dangerous look technically for stocks. Now, speaking of the next few weeks, the folks who we rely on for expertise around the options market and flows and that sort of thing, I got to tell you, they are bullish over the next few weeks in a not small way. And it has to do with options positioning. People have been buying puts by the boatloads or the truckloads here lately to hedge against something, I guess today's jobs report and or the election next week. As those positions unwind and the dealers have to cover their hedges where they short the securities to cover themselves on those puts, you could see a massive ramp up in this market. One of these experts in the option space who we pay a lot of attention to sees what we see longer term and has some voices, some very explicit concerns about the market right here over the next few months, but says that we could get that real classic blow off top before that you tend to get before you get a bear market. And so the setup is there for that to happen. Now, you look at it technically and so on and so forth. Our own technical work, technicians who I follow and so forth, they're looking at charts saying, the downside looks more likely in the near term. BCA's equity strategy team is expecting a poor November, believe it or not. But they're not looking at these options and derivative flows and so forth. And so I suspect that the options people may have it right. So it could be that we get a really nice rally. I think odds favor that next week into the end of the year. But nothing, of course, is guaranteed in markets. And the opposite scenario could get pretty ugly pretty quickly. But I think if it's going to get worse, if we're going to get that precipitous sell-off that I'm worried about, I think it's a 2025, maybe early 2025 affair. Looking at the dollar, remember we called this rally pretty much, or I should say we had a very bullish setup that we pointed out right here. You can see it's coming off. It's bouncing around that 104. This is today's action. Sold off on the jobs data, ramped up on the ISM prices data, and that's where we sit there. Gold, remember up in here, I've been saying gold just looks technically not good to me. 2 pretty good days of sell-off right now. Gold is down, 30 basis points. So it's not huge. And we like gold, and it's not a small position for us, and we're just going to hang on to it through whatever's coming. But it wouldn't surprise me to see gold come back and maybe test this range, and it could go a bit lower. Longer term, the setup is exceedingly favorable for gold, I would say. Next few weeks, anybody's guess. I would suggest maybe some more weakness. And then last but not least, the 10-year yield. Remember, same thing. We said this looked bullish right here when everybody was bearish and worried about the economy. And here we go. This morning, sold off heavily on bonds rally, but you can see they've come right back up and they're testing this 4.35 on the 10-year, which should be problematic for stocks, and I think it is for most. I mentioned that utilities are down 2%, but tech's riding high on earnings and, and optimism maybe over what's to come over the next few weeks. But make no mistake, folks, this is noise by definition. Correlations are all kind of screwed up right here. Fundamentally and technically, this is not the best looking setup, to put it mildly, for a rousing extended bull market going forward. We may very well get that, but make no mistake, clients, we will be crunching the data from every which angle and measuring, general conditions and the setup going forward. If we can just keep doing what we've been doing this year, we'll be thrilled. But there's some challenges ahead. And ultimately, that will lead to, I think, incredible opportunities during the next cycle. So I will leave it there. Thank you for staying with me that long. Hope you have a wonderful weekend, and I'll talk to you soon. Take care. Bye-bye.